Hi, it's David Kotok. Instead of Matt McAleer, I'm covering for him. It's the last day of the year. It's been a remarkable year. First, we want to wish every viewer, all our clients, our friends, our referring consultants, our staff, anyone who's viewing this YouTube, a Happy New Year. And please be safe in 2022. We look forward to next year. It's going to be a year of change. We'll deal with pandemic year 3, what it will bring. All we know about pandemics is each time we get to a new wave, we get a new surprise. We're going to look at the Federal Reserve's change in policy and how that's going to work out. My colleague, John Mousseau, is going to talk about the bond market at the end of the year. And we'll look at the stock market, which will be determined by whether or not the trajectory of earnings momentum continues. The earnings surprises have been remarkable. For 5 quarters in a row, they have exceeded the estimates. The S&P 500 index for the 3rd quarter of 2021 earned almost $54 a share. We'll see what the 4th quarter reveals in just a few weeks as earnings are reported. And we'll see what companies forecast for 2022 and what the outlook is. If this earnings trajectory continues, the stock market can go higher. It's based upon earnings. So it's going to be quite a year. The inflation issue is hot, maybe a little rollover, and become transitory, I'm not supposed to use that word, into a lower number. We'll see what interest rates do and what the Federal Reserve does, and we'll pay close attention to the stock market. Please be safe and have a Happy New Year.
Hi, it's John Mousseau. I'm the CEO of Cumberland Advisors. It is Friday, December 31st around noontime. My colleague David Kotok kind of gave you the setup on the equity side. On the bond side, we're closing the year very quietly. 10-year bond at 1.5%, a 10-year AAA muni at about 110. Those numbers were lower at the beginning of the year. They were roughly 0.9 and 0.7 to start the year, and they kind of peaked in March and have worked their way back down. Clearly, one of the issues this year has been the rise of inflation, which was running about 1.5% at the beginning of the year. As we close the year on a trailing basis, it's running now hot at about 6.8%. Do we expect that to continue? No. We expect to start to see, as we come out of this last variant, if you will, start to see movement from really the goods demand side to more service demand side. That should take some of the price pressure off. And we know also that every time we get another variant, the economic response is a little less volatile than it's been before. So we expect the economy to continue to do well as we go forward. Do we expect inflation to continue to run at this rate? No. We don't expect it to go down back to where it was at 2% or below either. So the real question for the markets will be, how do you deal with a longer term run rate of inflation that might be 3 to 4%, as opposed to the 2% that we've dealt with? We think interest rates probably do a slow rise, and probably some of that is from the Fed taking away their subsidies of bond buying that's already been started to taper, and of course probably raising short-term interest rates to send a signal that they want to fight inflation. So as we head into the year on the bond side, we start to think that real rates, which are very negative right now, will start to climb and become a little less negative as we go forward. Probably see a fair amount of bond issuance as well, because we know that the infrastructure program, which has been passed, will start to percolate a little bit, and that will end up with issuance on the behalf of some of these projects that the federal government is going to help out with. We hope you all have a great, Happy New Year. Please, out there, be smart, be safe, and we'll see you in 2022.